For my next acquisition, I'm gonna buy the United States and move it all the way to Mars.
It's a fair question. Why does everyone have their undies in a wad over the potential of the U.S. defaulting on its debt? Many news stations, especially financial ones, have been reporting on the anxiety, sleepless nights, loss of appetite, and frequent trips to the bathroom that the thought of a U.S. debt default has brought to the financial sector. If you want to understand why, we must first understand a financial theory concept that is known as the risk-free rate of return. The risk-free rate of return is like the apple that hit Isaac Newton on the head. It is the theoretical rate of return that an investor could earn from an investment that has effectively zero risk. As you know, if an investment has higher risk, like your Uncle Larry's company to invent a cure for hangovers, an investor will want a higher payout since Larry's unreliable nature makes it a risky investment. A risk-free investment is the opposite of that, and is often used as a benchmark for evaluating the potential return of other investments. The risk-free rate of return is typically based on the yield of a government-issued security, such as a U.S. Treasury bond. Because these securities are backed by the full faith and credit of the government, they are considered to be virtually risk-free, as there is very little chance that the government will default on its debt obligations. Investors use the risk-free rate of return as a baseline for evaluating the potential return of other investments, such as stocks, bonds, or real estate. Let's say a person can buy a U.S. Treasury bond for $100 and the bond has a 4% interest rate, which is the rate of return. In a year's time, that bond will be worth $104, which would net the investor a $4 profit. An investor could instead invest $100 in Disney stock. If the next MCU movie does really well, that initial investment could rise to $110 for a $10 profit. However, if they kill off Spider-Man and that movie does very poorly, that initial $100 in Disney stock might only be worth $90 in a year's time, showing a $10 loss.
And I'm not just talking about the money you paid to watch Tom Holland get his cute little butt kicked.
Hey! The risk associated with a corporate stock is higher than that of a treasury bond, which is why the potential payout is higher, but so is the risk that you might lose money. Keep in mind that the risk-free rate of return is a theoretical construct, as, here in the real world, all investments carry some degree of risk. However, the risk associated with government-issued securities is generally so low that financial institutions use them as a benchmark for evaluating other investments. The main reason that the threat of a government debt default by the U.S. is so alarming is mostly because it would throw this whole financial theory into uncertainty. It would be like if we found out that 2 + 2 doesn't equal 4 now, but instead equals
John Cena! 2013 called. They said you could keep that reference and they don't want it back. Oh!
Not to mention, many banks and corporations have a significant portion of their savings held in treasury bonds, which means they're the ones who won't be getting their money. That is why the possibility of a government default is so alarming.
Money isn't magic and I'm not a wizard.